Hello there, MSO here. In this video, I take you through IAS 19, which deals with employee benefits. I'll take you through two very detailed past exam questions. And by the time we are done, you will know how to attempt every single employee benefits past exam question you come across in any exam anywhere in the world. So let's begin. In the first question, we are dealing with a company known as McAljoy. We are told it's a public limited company. Let's see what the requirements are. So we're required to talk about the nature and the differences between a defined contribution plan and a defined benefit plan with specific reference to the company's two schemes. Apparently the company has two schemes, and we need to know what these schemes are. Then we will show the accounting treatment for the two pension plans and the IAS 19 employee benefits. So without wasting any further time, let me take you through this. Most importantly, telling you what a defined contribution plan is and what a defined benefit plan is. And then even more important, we talk about how these two plans are accounted for in or under the requirements of IAS 19. So let me tell you what these are, and then we come back to the question. So as we are reading, we'll pick things up. So let's start with a defined contribution plan. Let me try and simplify this for you. So under a defined contribution plan, let's even make life easy for all of us, right? Let's clearly state that. So IAS 19, employee benefits. So this is employee benefits. What the standard does is it provides for two types of what we call post-employment benefits. The first is a defined contribution plan, what I can call a DCP, and then we have a defined benefit plan, so a DBP. All right, so these are types of what we call them post-employment benefits. It means these are benefits that accrue to employees after their employment period has ended or when they are on retirement. Now, under a defined contribution plan, take note, the contribution is defined. And the defined benefit plan, the employee's benefit is what is defined. What does this mean? Let me clarify. So under the defined contribution plan, the entity, so let's do this. The entity, that's a number of things. So I need more space. So the entity pays a fixed contribution into a fund. So you can see the contribution is fixed or it's defined, right? The entity, say, has no legal or constructive obligation to make further payments. So the first point is what? The entity pays a fixed contribution into the fund. Then the entity has no legal or constructive obligation to make any further payment if the plan is unable to have funds to make pension payment to the employee upon their retirement. So, following from all of this, we can also say that following from all of this, there's something called actuarial and investment risk. This is placed on the employee. What do I mean by actuarial and investment risk? What it means here is that, let's say you are employed with your an employer. You are in as part of the company's pension scheme. You contribute, let's say, 6 or 7% of your monthly salary into this fund. If it's a defined contribution plan, what the employer is saying is, well, how much he decides to pay, let's say as a matching contribution, he tops up a contribution. That is the only thing he's defining. That's the only thing that is guaranteed. He's not promising you any further payments when you go on retirement. So if he makes payment into the fund, and let's say the fund accrues a balance, the fund has money, but when it is time for you to go on retirement and you are due to receive your payment, if the fund does not have money to pay you, the employer is under no obligation to satisfy your pension requirements to make any payments to you on retirement, because it is only the contribution that was defined. That's why I'm saying here that the actuarial and investment risk is placed on the employee, because the employer literally owes you nothing. You are on your own in this cold, hard, and this cold and difficult world. That is what it means under a defined contribution plan. So remember, under defined contribution, the contribution is what is defined, right? The entity pays a fixed contribution into a fund. They have no legal, no constructive obligation to make any further payments, and the actuarial and investment risk is placed on the employee. Let's look at a defined benefit plan. Here you can see, as the name implies, the benefit is defined. So what happens here? So under this, to make life easy, let me bring my arrow down here. Okay, I'm not the best of artists, so let's understand. So here the entity, remember here we said the entity has two things, so let's do a similar thing for this case. So here the entity has an obligation to provide agreed benefits to current and past employees. And similar to this, you say here we said what there was no legal or constructive obligation. But here we will say what the entity does have a legal and constructive obligation to provide employee benefits. So now that we've looked at this, we can now talk about what the actuarial and investment risk. So under this, the actuarial and investment risk will not be on the employee, will be on who? On the employer. Why? Because what? They have an obligation. They are obliged to provide you with agreed benefits. They actually have a legal obligation. They have a constructive obligation to provide what employee benefits upon retirement. So the actuarial risk and the investment risk is placed on the employer. So take note, the difference here is that here the benefit is defined. What you get as a benefit is defined. So because of that, the employer has what the actuarial and investment risk, they bear that risk. So if you want to remember the difference between a defined contribution plan and a defined benefit plan, remember that one says defined contribution, only the contribution is defined. One says defined benefit, it means the benefit you get upon retirement is defined. So it means what? Your employer is guaranteeing you that no matter what happens, no matter how bad the fund performs, I will still pay you a pension when you go on retirement. Right? So now that we know the difference between the two, let's apply it to the question. Okay. So let's read through and see what we have here. And we'll see your life will be easy after we've gone through this. So we are saying Macau Joy is a public limited company and they are a leading support services company, okay, which focuses on the building industry. The company would like advice on how to treat certain items under IAS 19 employee benefits. Good. The company operates the Macau Joy Pension Plan B, okay, which commenced on 1st November 2016, and Macau Joy Pension Plan A, which was closed to new entrants, interesting, from 31st October 2016, but which was open to future service accrual for the employees already in the scheme. The assets of the schemes are held separately from those of the company in funds under the control of trustees. This is the norm in different territories around the world. Then the following information relates to the two schemes. Good. So at least we know that there is pension plan B and pension plan A. So let's see which one is a defined contribution plan and which one is a defined benefit plan. So the terms of the plan are as follows. This is for what? Macau Joy Pension Plan A. Let's see what they tell us. Employees contribute 6% of their salary to the plan. Okay. Macau Joy contributes currently the same amount, that is what? Also 6% to the plan for the benefit of the employees. Okay. Nothing new here. Watch here. This is where the gold is. On retirement, employees are guaranteed a pension, which is based upon the number of years service with the company and their final salary. This alone should tell us that pension plan A, because they are guaranteed a pension, this is what? Can you guess? This is a defined benefit plan. Remember we said under defined benefit plan, the employer promises, guarantees you, has the legal and constructive obligation to make payments to you, even if the pension fund does not have enough funds to satisfy you. So this is a defined benefit plan. So we know that Macau Joy's pension plan A is a defined benefits plan. Okay. So now let's continue. And they give us some details to use for the computation. We'll look at that shortly. So we can skip all of this for now. Yeah. Then let's look at Macau Joy Pension Plan B. So under Plan B, what happens? Under the terms of the plan, watch this carefully. Macau Joy does not guarantee any return on the contributions paid into the fund. And here again, they are giving you another clue. The company's legal and constructive obligation is limited to the amount that is contributed to the fund. So this is clearly what? Only the contribution is defined. There's no, watch this, there is no legal, there's no constructive obligation. As you can see clearly, there's also no guarantee on any return. So this is clearly a case of what? Plan B is a defined contribution plan. So plan A is a defined benefit plan. Plan B is a defined contribution plan. And that's it, really. So if you're answering a question, you can use the points we made here to make your case, right? So under IAS 19, there are two types: defined contribution, defined benefits. Obviously, these are post-employment benefits, right? And this will help you put out your answer clearly. Let's not waste time. Time is a valuable resource. So let's come to the next question, which deals with accounting requirements. So obviously here they said discuss the nature of. So discuss the nature of and the differences between a defined contribution plan and a defined benefit plan. We just did that on the right with reference to the company's two schemes. We've done that. So if you can do this, you have 8 marks, right? Next is to show the accounting treatment for the two plans for the year ended 31st October 2017 under IAS 19. So once again, let me tell you how the accounting will be done. Then we can apply it to this particular question. So here, let's look at the accounting requirements. For accounting, it's very different, it's very distinct. So once again, we have IAS 19, right? We know there's something called a defined contribution plan. We know there's something called a defined benefit plan. Defined contribution plan is the easiest to account for. Under this, we are saying that all current period costs, these are contributions, are generally recognized as an expense in the current period. That's it. So under this one, they are generally expensed to P&L, right? Obviously, if there's a payable component, let's say the company has not yet made the payment, then there will be a liability on the balance sheet, obviously, most likely a current liability for that portion of the payment that has not yet been made. For those interested in the complex part, so anytime a contribution which is not expected to be settled wholly within 12 months is made after the end of the reporting period, then these have to be discounted to their present value. But it's not a big deal in this case. Let's look at defined benefit plan. This is where it's interesting. Here, there will be 2 requirements. One for the statement of financial position, and then one from what? The statement of profit or loss and other comprehensive income. So let's look at both, right? So let me bring an extension here. Once again, pardon my drawing skills. So the statement of financial position will have 2 components. So here you have what? The fair value of plan assets, that's a pension scheme assets. Then you also show the fair value of plan or scheme what? Liabilities. Then IAS 19 requires you to, you can net them off and have what? A net pension asset or liability. So take note, on the balance sheet, you need to show 2 things, actually to be 1 in the end: the fair value of the plan assets and the fair value of the plan or scheme liabilities, right? Then you net them off to show a net pension asset, so a net asset or a net liability, depending on which one is larger. So if your plan assets are bigger than your plan liabilities, then you have what? A net pension asset. If your plan liabilities are bigger than your plan assets, then you have what? A net pension liability. So this would be what the balance sheet, the statement of financial position. What goes to the income statement or the P&L? Here, we have one portion. So here, one portion goes to the statement of profit or loss. Another portion goes to other comprehensive income. What goes to profit or loss is essentially what? Your expenses, really. So what do I mean by expenses? So there are a number of expenses, like what? We call them service costs. Then you have what? Interest expenses. Then you have what? Return on investment. So these 3 will go to P&L. And the service costs, we have 2 types. We have, so here we have either current service cost or what? Past service costs. What goes to other comprehensive income? It's essentially what? The let me do this well. So what goes to OCI will be what? The remeasurement component of what? Of this, the plan liabilities and what? The plan assets. So as we'll see shortly, any remeasurement component of what? The plan liabilities and the plan assets will be taken to other comprehensive income. Take note, the link between what? The OCI and the balance sheet will be what? Through the remeasurement components here. So now that we know what goes where, let's see. There's a template I want you to memorize. Once you memorize that template, trust me, nothing at all will beat you anywhere in the world. Remember, first thing I've said is what? On the balance sheet, we show fair value of plan assets. So we show fair value of plan assets. Then we show fair value of plan liabilities, right? Then we show the net. So what will go into the fair value of plan assets? Let me show you that. Just memorize it and you'll be fine. So your fair value of plan assets, this is a standard working. I encourage you to memorize it. You just take your opening fair value of plan assets, right? Then you add any return on investment. This would typically be a rate of return applied to the opening value. So take note, you apply this return on the opening, and it's because what? Companies invest their plan assets to get a return. So you add a return. Then any contributions paid into the fund in the period you add it. So we call this contributions paid in. You add it. So any contributions employees and employers made into the fund for the year, you add. Then you deduct benefits paid to retiring employees or those who had triggered benefits. So you deduct benefits paid out. Then what this should give you should be what? Your expected fair value of plan assets. So it will give you a certain figure. But there's someone called an actuary whose job it is to value what? Pension funds, and to tell you that, well, based on his actuarial and statistical modeling, he feels that the value should be so amount. So you compare it to what? The closing per the actuary. Then the difference between the closing per actuary and what you get from this computation is what we call the remeasurement component. Remeasurement component. This is a balancing figure. So this figure here is a balancing figure. This is what will go towards other comprehensive income. It can either be a gain or what? A loss, depending on which difference or which direction the difference takes. So take note. So remember here, I said what? The remeasurement component here will arise from the difference for what? Either the assets and what? The liabilities, right? So here, remeasurement component here, you can see is what? Difference between what you expect the assets to be and what the actuary said it should be, right? So this is it for the assets. Whatever figure you get as the closing per actuary right here, this figure, right, is what you bring as fair value of plan assets here. Let's look at the pro forma for the liabilities. Once again, just memorize this. It's quite intuitive if you ask me. So just follow through. So fair value of plan liabilities. Here, to as usual, you start with the opening value. So what's the opening? Then instead of a return on investment, it only makes sense that for a liability, you will incur what? Interest expense. You won't get money, you pay money. So you add what? Your interest expense that you are incurring. Once again, this will be computed on this opening value. The question will give you the rate of return always, so don't worry. Then here you add something called service cost. You remember here I mentioned what? We have service cost. And there are two types: current service cost, and past service costs. So you add your service cost, so both your current service cost and your past service cost, so you add them. Then if you compare it to this, once again, benefits paid out, you deduct benefits paid out. Then this will give you what? The expected fair value of plan liabilities. Then as usual, Mr. Actuary will come into the picture and tell you, well, I expect the closing, so closing per actuary. He'll tell you, I expect the closing to be a certain figure. Then based on the difference between this figure and what you got, right? Based on the difference, that will go as a remeasurement component. So remeasurement component, obviously, once again, this is a balancing figure. It could be a gain or a loss. This will go towards other comprehensive income, right? So take note, this is how you compute for the fair value of plan liabilities and fair value of plan assets. Now we've seen what goes where. So please take note. Let's start the question. It's very simple. We'll apply it to two questions. You realize how easy it is. So once again, let's run through quickly. There is an opening value for the plan assets, the opening figure, right? Then a return on investment is applied, which is a rate of interest on what this opening figure here. Then you add any contributions paid into the fund. You deduct any benefits you paid out to employees. That gives you the expected fair value. Compare it to what the actuary said it should be. Then you get a remeasurement component, right? It's very intuitive, very straightforward. Let's look at the liabilities. For the liabilities, once again, start with the opening liabilities. Compute an interest expense, which is a percentage on this opening figure here. Then instead of adding, take note, instead of adding contributions paid in, because you don't contribute to liabilities, right? What you do is what? You add service costs, which is your expense. So you add your current service cost, you add your past service costs. Then you can deduct benefits paid out. You get your expected fair value compared to what the actuary said it should be. Then what difference is what your remeasurement component that will go to OCI. So if you can note the difference here, the key difference between the assets and liabilities is what? Everything is the same apart from what? The contributions paid in, which will be replaced with what? Current service costs and past service costs for the liability. Take note, right? The interest component, one is a return, one is what? An expense, but it's still computed on the opening value. So now that we know this, let's go to the question and start. So they say, show the accounting treatment for the two McAljoy plans. So at least we've detailed here that for the defined contribution plan, we're just going to what? Expense how much they contributed into what? P&L, and that's it, right? Okay. So let's come back here. Okay, so let's start with the easy one, which is the defined contribution plan for pension plan B. So watch here. They are saying that McAljoy does not guarantee any return. Okay, we know this. The company's legal contribution, it's limited to amount contributed. Okay, watch this. So contributions paid by the company for the year is what? $10 million. Contributions paid by the employees is $10 million. And the defined contribution plan is a contribution paid by the employer, by the company, by the employer, this 10 million, that will be recognized as an expense. What will be paid by the employee will be deducted from the employee's salary when they are paying them their benefit for the period. So this is not a cost to the employee, the employer. It's just how much the employer paid. This 10 million that will be recognized in P&L. Take note, you don't recognize the employee's contribution. It's the employer's contribution. That's a cost to the company, right? So let's come here. and let's answer. So we say for McCalljoy pension plan B, we say what? No assets or liabilities will be recognized, like we said earlier, right? So the contributions paid by the company of what? Right here, can you see $10 million? So of $10 million will be charged to profit or loss. That's all, you're done. Then let's even add this point to show we know our stuff. We say the contributions paid by the employees will not be a cost to the company, but will be adjusted in calculating the employee's net salary, right? So this is quite simple for pension plan B. Let's look at pension plan A. That's when we need to use all of these models and stuff here. Okay, so this is plan B, done. Let's look at McCalljoy pension plan A. All right. Plan A. You can see all the information given us here. Can you see present value of obligation? I mean, these figures here. We literally have everything we need. Can you see? All of these. So we just have to slot them into current service costs, pension, benefits paid, contributions paid out. So we just need to slot this into our templates and we are good to go. So if you remember, let's just take a quick look. We need to what? Work out the fair value of plan assets. So we need to work out fair value of plan assets. Then we work out fair value of plan liabilities. Then we work out what goes to P&L, which will be what? Service costs, interest expenses, and any return on investment. And then we do the remeasurement component here, which will be taken towards other comprehensive income, right? So let's start. Let's start with the balance sheet first. That's easier to do. So we say, say fair value of plan assets. If you remember our template, we said the first thing is what? The opening figure. Now, these details were given to us for the year to what? For the year to 31st October 2017. So watch this. Fair value of plan assets at 1st November 2016. This is the opening. Was what? 190. So we put 190 here neatly. Remember the second thing I said was what? Return on investment. Return on investment. So the question will give us an interest rate. And if you watch, good, it's at the bottom here. The interest rate on high quality corporate bonds at 1st November 2016 was 5%. 31st October 2017 is 6%. Remember I told you that you need to use the opening figure. Remember I told you do this on this figure, right? So the interest rate you pick must be the opening. So here we need to pick what? Our 5% here. So the interest, this will be 5% of what? 190. Okay, what would this give us? 5% of 190, calculator. Okay, this gives me 9.5, right? What did I say we add next? Remember, I said contributions paid in. let's come back to the question. For this one, can you see total contributions paid to the scheme was what? $17 million. So we add what? 17. Remember I told you deduct what? Benefits paid out. So let's come back here. Pension benefits paid is what? 19 million. So you deduct 19. Okay. And I told you all of this will give you what? Your expected value. So let's sum this up and see what we get. So my calculator, I have 190 plus 9.5 plus 17 minus 19. So this gives me, let me clear this first. This gives me 197.50. Then let's say closing per actuary. So let's come here. Fair value of plan assets at 31st October 2017. Actuary is saying it should be 225. So we put here what? 225. So the difference between 225, which is the actuary's value, and what we got will be the remeasurement component that goes to other comprehensive income. So 225 calculator minus 197. This gives me 27.50. So I call this my remeasurement component, which will go to what? OCI. Now the question is, would you say this is a gain or a loss? To me, this is clearly what? A gain. Why is it a gain? You were expecting to have 197 as assets. Actuary is saying that no, you actually have 225. Assets are good things, right? So you have more of a good thing. This is clearly a gain, right? I hope that analogy helps, but this is clearly what? A gain, a remeasurement gain that we take to OCI. Let's look at the fair value of plan liabilities. So fair value of plan liabilities. As usual, remember I told you there's an opening value. So here, let's come to this side. You can see present value of obligation at 1st November 2016 is what? 200, right? So our opening is 200. Remember I told you the next thing you add is what? Your interest. I told you it's computed on the opening, and we still use the opening rate here. Please don't be deceived into using the closing 6%. No, always use the opening rate. So here to be what? 5% on 200, which is the opening value, and that will give you 10. Then what's the next thing I told you add? Remember, you add your service costs. So let's go through the question and see service costs that they gave us. Good. Can you see here? We are told current service cost is what? 20. We don't have any past service cost in this question, so we can just move on with our lives. We just say current, but take note, if you had past service cost, you'd have added it, right? So yeah, just add what you have. Current service cost is 20. Then what do you remember? I said the next thing you deduct is what? Benefits paid out. So benefits paid out. Once again, is this figure here? Pension benefits paid of what? 19, right? So you deduct 19. Then this will give you your expected value. So what is our expected value? My calculator. So I need 200 plus 10 plus 20 minus 19. That gives me 211. So 211. Then what do? I compare to what the actuary said, right? So closing per actuary. What did they say? Let's come here. They said what? Present value of obligation at year end, 31st October, is what? 240. So they got 240. So I compare their 240, so 240 minus 211, I subtract and I get 29. So I have 29 here. So this is my remeasurement component. This will go to what? OCI. Now, once again, I ask you a question. Is this going to be a remeasurement gain or a remeasurement loss? This is clearly a remeasurement loss. Why? You were expecting to owe 211. The actuary said, no, hold on. As an actuary, I'm telling you on authority that you actually owe 240. So you have more liabilities in actual fact than you thought you did at 211. So this is what? A loss, a remeasurement loss. Take note of this. So now that we have the fair value of plan assets figure, so we use this as the assets, then we use this as a liability. Remember I told you the balance sheet will show one figure. So we say statement of financial position. So this is an extract. It will show the net as one figure. So we say fair value of scheme assets. Some people like to use plan, whatever fits you, assets. What did we get? Remember we said assets would be what? 225. So we put here 225. Then fair value of scheme or plan liabilities. What did we get? Right here, 240. So you can see clearly this will give us what? A net pension liabilities of 240 minus 225. We have 15, right? So we say 15, and we call this what? Our net pension liability. That's it. So this is what you put on your balance sheet right here. This is what goes to your balance sheet. In the end, you recognize just one line, net pension liability of 15. Now let's go to the statement of profit or loss. So statement of profit and loss and other comprehensive income. What will show there? Remember I told you it's a long way up, I guess, but P&L shows what? Your service costs, your interest expenses, and return on investment. So we need to pick these things. So all I need really, I need my return on investment, this figure 9.5. I need my interest expense, this figure 10. I need my current service costs. That's all. That's why I take to profit or loss. So 3 figures. So this is what okay. P&L extract. So I just write what? My current service cost. This is an expense. What did I get? I think it was here 20, this figure. So I put here 20. Then I have my interest expense. This came from the liability, if you remember. What did I get? 10. So I add 10 to it. Then return on investment. If you remember, this is from the asset. So add what? 9.5. But take note, this is income. So you have to net off 9.5. When you net everything off, it's going to be what? 20 plus 10 minus 9.5. This will give me 20.5. So this is the net expense that will be, so net expense in P&L will be what? 20.5, right? Then what goes to other comprehensive income? So OCI extract. Remember, OCI only takes the remeasurement component, right? So we need to go and pick the remeasurement component for the asset. Remember, we said the asset had a gain of 27. The liability remeasurement component had a loss of 29. So it's the net of the two, but let's show them separately and net them off. So let's say remeasurement component, which is what from the fair value of plan assets. I think that gave us a gain of here 27.5, right? So since it's a gain, let me just use negative 27.5. Then let's do for the next one, remeasurement component. This time from what? The fair value of plan liabilities. What did that give me? I got what? 29, a loss of 29. So 29 here. So you can see I'll have a net loss overall, right? So what is it going to be? So effectively 29 minus 27.5, right? I think that should give us 1.5 million. So 1.5. This will be what? My net loss in OCI. So that's it. We have one more question to do, and you realize how easy this topic is. So let's look at that one as well. So watch it. Here, you can see for pension plan B, they give us information about fair value of plan assets, contributions paid in by employee, interest rates on blah, blah, blah. We ended up using the information for what? The assets. But they even gave us a clue because they didn't even give us fair value of plan liabilities for pension plan B. So a smart student will know that this is clearly what? Not a defined benefit plan. Because for a defined benefit plan, you'd have needed what? The fair value of the plan liabilities as well. Have we answered the question? Yes, they said shows the accounting treatment for the two plans. Yes, we've done that. If you can do this, 8 marks. Let's look at yet another question. Right here, what's the requirement? They're saying prepare extracts from CAPES. And please take note, this one is a little different, so watch it carefully. From CAPES statement of financial position at 31st March 2019, and from its statement of profit or loss and other comprehensive income from the year ended 31st March relating to the defined benefits plan. So what does the question say? IAS 19, employee benefit is applied to all employee benefits other than those to which IFRS 2 share-based payment applies. That's true. Accounting for short-term employee benefits is relatively straightforward. It's true, just an expense in P&L, payable in balance sheet, yeah. However, accounting for post-employment benefits can be rather more complex. This particularly applies where post-employment benefits are provided by way of defined benefit plans. We just saw that it has a lot more workings, but like we've seen, there's a template which will make your life very easy. CAPA provides post-employment benefits to its employees through a defined benefit plan. The following data relates to the plan. So here, you can see we have present value of obligation at year end, fair value of plan assets at year end, current service cost, benefits paid by plan, contributions paid into plan, yield on high quality corporate bonds at start of year. That's it. So let's chuck these numbers into our template and see what we can do in this particular question. It's very easy. Like I told you, once you do this, you realize that you are very confident you can attack any question anywhere in the world when it has to do with post-employment benefits. Take my word for it. So in this second question, as usual, let's start with what? The statement of financial position. So let's start with our fair value of plan assets. So here, what goes into the fair value of plan assets? We know that it's a number of things. So what is the opening fair value of plan assets? Watch it carefully. Here, they give you the fair value of plan assets at year end. So even though these two columns here, this one and this one here, deals with the year ended 31st March. It's for 2019 and 2018. So what this effectively means is that the 2018 year-end figure of what? 30,000, this one, will be the year start figure for 2019. Don't forget that we are working for what? 2019. So please don't be deceived into picking the wrong figure, right? This is the year end for 2018. So it must be the year start for 2019. So it means the assets, the opening figure will be what? Watch it carefully. This is year end, 30,000. So our opening is what? 30,000. Take note, that is the opening figure. Then we add our, remember, return on investment. Here we are given two rates, 10% and 9%. They are saying that 10%, right? And here they are, you see, they use year end here, but here they use start of year. Tricky. You might be tempted to pick the 9, but this rate, the rates are for what? Start of year. So it means start of 2019, the rate was 10, not 9. Please take note. This is the trick in the question. All of these are year end, but this is what? Start of the year. So you must pick this is start of the year, 10%. So it's going to be 10% of what? 30,000. That obviously give you 3,000. What next? Remember the next thing we said, what? You add what? Your contributions paid in. If you watch here, we have contributions paid into plan of how much? 5,800. Please take note once again. Here you want the contributions paid in the current year. Those ones are not opening balances. You want the current year figure. So in as much as you are picking the opening from here, please take note is the current year contributions paid into that you are looking for. So you pick what? 5,800. Then you less your benefits paid out. Once again, it's here, benefits paid by plan of what? 8,000. So you deduct 8,000. What does that give you? So let's add that up. So my calculator, 30,000 plus 3,000 plus 5,800 minus 8,000. That gives me 30,800. So 30,800. So this is my expected value. You leave a space as usual. So we say closing per actuary is what? So if you watch here carefully, fair value of plan assets at year end, actuary said they are expecting how much? 31,000 right here, right? So we come here and put here 31,000. So what is the difference between 31,000 and what? 3,800? So that gives us 200. So you put here 200. We call this, as usual, your remeasurement component, which will go to OCI. Is this a gain or a loss? Easy. I was expecting to have good news, good assets of 3,800. Actually said, no, we actually have 31. I've made a gain, right? So this is a remeasurement gain that will go to OCI. Let's do the fair value of plan liabilities. As usual, you pick your opening. So same method as the assets. We pick that opening from what? The last column here. So by extension, it means our opening will be what? This figure, 33,000. So opening is 33,000. Then we add our interest expense, which will still be what? Use the rate of 10%, remember? So it will be what, 10% of 33,000. That'll clearly give us 3,300. Then, instead of adding any contributions paid in, what do? You add current service cost and past service cost. Here we have what? Current service costs. And please take note to use a current year figure of what? 6,000. So you add your current service costs of 6,000. Then you can now less your benefits paid out. What do we have? Benefits paid by plan here. So how much? 8,000. Okay, so what does that give us in terms of our expected value? So our expected value, let's add that up. We have 33,000 plus 3,300 plus 6,000 minus 8,000. That gives me 34,300. So I have 34,300. What does actuary say, Mr. Actuary? So closing per actuary. What does he say? If you come here, present value of obligation at year end, he is saying he expects to have what? 36,000. So I put here 36,000. So the difference between my 34,300 and his 36,000 is what goes towards OCI. So this is my remeasurement component, which will go toward OCI as a balancing figure. So it's going to be 36,000 minus 34,300. And that gives me what I got was 1,700. Is this a gain or a loss? This is clearly what? A remeasurement loss. Why? I was expecting to owe 34,300. Actually says I actually owe more, which is 36. I've made a loss on remeasurement. So, statement of financial position extracts will show what? Fair value of plan assets. What did I get? 31,000. Then my fair value of plan liabilities. What did I get? Right here, 36,000. So what's the difference? That gives me clearly 5,000. So 5,000. But this is clearly what's a net. So I call this my net pension liability. So that does it for the assets. Now let's go to our statement of P&L and other comprehensive income. What does that give us? So let's do our P&L extract. Remember under P&L, the things that go there will be what? Your current service cost, past service cost. So here, I remember what we have as well. Current service cost of 6,000. Our interest expense of 3,300 will feature. And then our return on investment will also feature of 3,000. That's all. So we have current service costs. What did we get? 6,000. Okay. Then our interest expense. What did we get? 3,300. Okay. Then we take out what? Our return on investment. That gives us 3,000. So we less 3,000. What does that give us? So we have 6,000 plus 3,300 minus 3,000. That gives us 6,300. 6,300. So this will be what? Our net expense in P&L. Final thing to do is what goes to other comprehensive income. So OCI extract. Remember, OCI just takes the remeasurement. That's all. So we just come here and we pick the remeasurement components, this figure for the assets, the gain, then the loss of 1,700 for the liabilities. Clearly, we have a net loss in OCI. So we say remeasurement component from what? Fair value of plan assets. We got a gain of what? Here, 200. So that will be here. Then our remeasurement component, which came from what? The fair value of plan liabilities. We got a loss here of 1,700. So 1,700. This will clearly give us what? 1,500 net loss in OCI, right? So this is our net remeasurement loss in OCI. So that is it. If you can do this, you're going to score 11 marks. So for any question you face in any exam that has to do with post-employment benefits under IAS 19, i.e. defined benefit plans and defined contribution plans, this is how you go about them in an exam. So if you have any questions, please feel free to leave them in the comments below. And I'll leave a link to the downloadable version of the PDF, both in the description and in the comments. So if you love this, which I expect you to, please don't forget to smash that like button. And don't forget to share this video with your entire network. I'll catch you in our next video.